Hey there, folks. This is Mitch Firestone with Precision Trading Labs. Welcome to the weekly Friday wrap up in this series where I've been looking at issues of Barron's each week in order to identify high probability setups that come out of selective articles. Um, just to be clear, some of the setups that I do fit with the thesis that they lay out in the articles. And then sometimes I'm doing the exact opposite. Really, the whole point of this is for me to kind of be exposed to a group of symbols that I might not necessarily look at in the course of just having a standard watch list. And so that's the basis of what I'm doing here. So what I'm going to do is I'm going to go through, we're going to rip through a number of setups that I built based on what I found in Barron's, and then I'll show you, of course, what transpired with them. And then at the end, I'll also have a new setup as well. So what we're looking at here is a chart of Rocket Mortgage. And so I was looking at this. I believe they featured this in the November 10th issue. And so this is a daily chart of Rocket. And so right here, we were kind of sitting midway between these zones here. This is what's in at Precision Trading Labs we refer to as a demand zone. This is a supply zone. What this demand zone is where price came down, consolidated, and let me just spread this out a little here. So price came down, consolidated, and then notice that major pop there. That represents an exhaustion of sellers. No one was willing to sell here anymore after this point of consolidation. And if we think about the shares that are acquired by buyers, we can think of those as the demand for shares. We can think about the shares that are offered up by sellers. Those are the supply of shares in this region. And so right here, supply and demand are in balance. Once there is an exhaustion of sellers, what's left in its wake is only demand because there's no longer any supply. And so when price returns to this region, there's the expectation that there is another wave of buying that's going to occur here. We could think of this as almost untapped buying pressure. Okay, and so that's the story of that demand zone here. What? Excuse me. Um, that's the story of that demand zone here. And then up here, it's the same exact story, except in reverse. This is an exhaustion of buyers here. And then when price returns here, again, we're anticipating that there's going to be a wave of selling. Okay, and so that's a supply zone there. And so when we set up a trade, this is where we get in at the front of that demand zone there, and then we set our protective stop back here. When price drives through here, and after a little wiggle room, if it drives through and it doesn't work, well then our trade has failed, and then we have to be willing to take a paper cut at that point. So when price returns here, we can express a trade here. And so the simple way of doing that, of course, would be to buy the stock. But other things that one could do, of course, would be to buy a call, or for people that like to sell premium, collect premium, one could also, of course, execute a bull put vertical credit spread. So those are all ways of expressing a trade at that zone here. And then up here, of course, one could do the exact opposite. So that was the trade thesis for Rocket here. So if we now go to the live chart, here's what we were just looking at here. Price actually started to come down towards this demand zone here, and in fact, I actually really liked this particular setup because it was going to drop below its lower Bollinger Band. Also, we had the 200 period simple moving average that was going to be intersecting with that. So all of that confluence of good factors there was going to contribute to a great trade down here, we thought. Having said that, it didn't actually make it down there. It came close, and then it popped here. So when it ended up getting up to this supply zone here, well, at that point, then we shorted it. And so again, the way people expressed a bearish trade out of here. And so, of course, some people shorted the stock. One could, of course, also buy a put, and then, if again, for people that wanted to collect premium, one could, of course, execute a bear call vertical credit spread. Okay, so those are all ways one could, of course, express the trade up here. So when price got up to 1787, that's where all of those various types of trades triggered. Okay, so when price came up here, it basically stalled up here for about a day. Then there was a thump down there, another little move down. Then it kind of went, came down, consolidated a little, and then yesterday there was actually this huge relief rally in connection with artificial intelligence that was triggered by NVIDIA's earnings, and so price kind of ripped up there. Which I was actually kind of disappointed to see, since we're obviously looking for this to head down. But then in the afternoon, the market pretty much gave everything back and more. And so when price came down here, we just figured, you know what, we're going to close this trade here and just take the profit and run. So at that point, we had bought that. We bought the January 16th expiration, expiration put with the 19. You might be looking at this and see there was a 19.2 strike, which kind of looks a little bizarre. That's because Rocket actually issued a special dividend at some point in the last few months, and so there was an adjustment in the strike prices there. So that's why it's a $19.20 strike. But anyway, so we bought that put at 285 at 1787, and we got out at 340 when this thing got down to 1630. That was a 55-cent profit, and so that was a 19% gain. Obviously, if you bought a five puts, then you made about 275 on that. So at any rate, that was that trade. If we go back to the setups. So here was another setup that we had. This was Kroger. So a week or two ago, Barron's had done a story about uh, the unloved consumer staples. Consumer staples, as represented by the XLP ETF, a number of the holdings in there, as well as the ETF itself, have underperformed the market. And I believe that it was actually the worst performing of the 13 major sectors. And so the thesis of the article was looking for relative strength in the XLP in order to then effectively go bargain hunting. And so that was the basis for that. So I went through the article, and they had mentioned Kroger, and then they had also mentioned Instacart, or the company that's behind Instacart. So we ended up actually getting setups based on both of those. And so I'll take you through those. So right here, there was a drop-based rally here. This is a demand zone here, but in fact, this had already occurred. Okay, so had I looked at this, a few days before, this would have been the basis for a bullish setup here out of this zone. But this had already occurred, and I had not looked at this chart. So at that point, then I did notice above there was this basically adjoining supply zones here, and so if in fact price came up here, we would execute a bearish trade of some sort, as I described earlier. And so, looking at what the options that were offered, I believe there was no February expiration, so it was either a choice of the January or the March. And because of the fact that we were kind of below here, and I didn't really know how long it was going to take, I figured we might end up just buying the March. Obviously, we're not going to be in the trade for anywhere near that long, but we buy enough time so that we don't get beaten up by time decay in case we get stuck in the trade, let's say for 10 or 20 days. So that's why we're looking, a bit further out. We're not just buying, 2 or 3 weeks, or even 5 or 6 weeks. So we're waiting for price to come up here. So that was the trade thesis. You can see that was on November 10th. So if we now go to the live chart here, and let's grab that. So here's the chart here, and what happened was price actually zipped up to that supply zone here. Okay, so this is the area that I had said we had kind of missed the boat there. So it had actually come up to that supply zone there, drove into there, and then dropped. So we ended up buying the March call, the 67.5 strike, so that we actually bought this basically right at the money. That was the at the money call. These things are denominated, I believe, in fives, and so then there was the seven. The if we were going to buy it in the money, we would have bought the 70. We were trying to keep the premium down for a number of our community members and subscribers, so that's why we opted to go with the 67.5, which essentially was the at the money call. Excuse me, at the money put. So price came up, drove into that zone, and then dropped here. We got that nice thump down. That was yesterday. In fact, that was during that 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 drop in the market yesterday. And so we basically got out here. So we bought it at 460, got out at 540, and then that was around 65.20. So that was right about there. And so we made about 80 cents on that, and that was a 17% gain. So that was in the course of about what is that, three days. All right. So that was that setup. Go back to this. And actually, before I go on, the usual disclaimer here. Precision Trading Labs, we're neither money managers nor financial advisors. Everything we do is for information and educational purposes only. And in the case of our subscribers and community members, it's to help them acquire mad trading skills. All right. So let's take a look at these other setups here. And so here it was here's the company it's behind, Instacart. Okay, and so price then here was a base drop here. Again, I didn't really care about their trade thesis, and so right here there was a demand zone here that goes back. I guess back about a little over a year or so ago. But right here there was this base drop formation here. Actually, pretty much it's a bear flag there, of course. And so we had that area. When price returned here, there was the expectation that once we got here, we could execute a bearish trade. And so in terms of the option, we suggested buying the February 20th expiration, the 44 strike, so that was a dollar above here. And so we would be buying it about $2.20 in the money. Okay, so that was the basis for that. So if we now go to the live chart again, and here is cart. So you can see price came up here, basically kind of hovered right at that zone here, and now it basically started to drop yesterday, more or less didn't do a whole lot today, and so that's where we are now. So we got in here at 460. Again, the trigger was when it reached 4180, and now I checked the option platform earlier, and so when this thing was sitting at 4045. This thing was worth about the projected theoretical value of the put was at 515. You can see now. I think when it closed, it actually closed at 40.20, so it's down about another 20 cents. So this is presumably worth another dime or so. So this is probably sitting at around 5.25, 530, something like that. So anyway, so we're in that trade, and then I'll go for the last one that we're actually in, and then I'll show you a new setup. So the one we're actually the last one was they were talking about the Carnival Cruise Line in one of the recent issues of Barron's. And so again, here was a demand zone down here. Here was a supply zone here. And the thought was if we ended up triggering a bullish trade here, that would actually represent a nice target here, because right here we had a rally base, not necessarily a zone that I would short, but in terms of the where line establishing a target and risk reward, this actually kind of laid out nicely here. Here's where we get into the trade. Here's where we get out if it didn't work. Okay, and each one of these rungs of this ladder represent 1 unit of risk here. So in fact, if you got in here and you got up to there, that would be a 1-to-1 return on the trade. That would be a 2-to-1. That would be a 3-to-1. And so you can see this is something that would presumably get in the way of the trade. And so at the 3-to-1, and that would lining up with the 3-to-1 area, that all kind of made sense. So this is where we actually established that as the target for this trade. Okay. And then, of course, up here, this would have been certainly a logical second target because this would be a place that we would actually really, seriously consider shorting. Okay. So that was the trade thesis here. Again, the demand zone there, supply zone there. So if we now go again to the live chart here and grab that. So you can see price drove in here, kind of struggled in here for about a better part of about 2 or 3 days. We actually got a nice pop out of there today. So maybe this thing is now on its way here. But again, that's our target there. So when we got into this at 25.80, that was the trigger for the trade. We got in at 255. We bought the January 16th expiration call here. We bought the 25, which essentially is at the back of this zone. So we bought it obviously about 80 cents in the money. So again, we got in at 255. I checked the option platform before I started to do this recording, and it was where the stock was sitting at 26.60. The option had a kind of a mid value of 290. So, it's up about 35 cents. Obviously, that's not really what we're looking for. We're looking for this thing to obviously get up to somewhere in the vicinity of, let's say, 28.80, 28.60, somewhere in there. And that would be our target. Depending on how it arrives here, if in fact it makes its way up here, this will be actually a nice area where we would actually effectively almost hit the reverse button and buy a put up there, depending on its arrival here. So anyway, that's the story with the Carnival Cruise Line. And then I will leave you with a and actually a new setup. So here was so here was the company here, Crown Holdings, and this was an article they had done, and in fact, I think I have some notes in here. They had talked about in this article that this was a bottling company, or I should say a canning company. And they said it had low valuation, good cash flows, major big name customers, Coke, Heineken, WD-40, and they were expecting a 30% share increase with a typo in the next 12 months. So anyway, that was their trade thesis here. And so, in fact, let me just put this back to the 2-hour chart here, and let me just spread this out a little. So right here was the rally formation, and so this is where I was looking here. Here was the when I looked at this article, we were kind of sitting around here, and so but then price kind of came up here, and then it basically started to head down to this demand zone here, and so this is where we were kind of getting all excited, waiting for this to get here. Alas, it turned and now is actually started to head up here. And so unfortunately, we didn't get this long trade here, and I was almost going to just kind of just tuck this thing away. I was going to, just leave the alert that I had set here, and just kind of move on and just kind of tuck this chart away. But I decided for some reason to just take another look at this, and so let me just show you here what I was looking at. Let me get these indicators off here just for a second, just so we can see things a little clearer. And what I was looking at here, if you notice in this very very bearish move down here, there are all of these overlapping bodies and overlapping wicks in here. And so when you have overlapping bodies and wicks, that essentially means that there is some consolidation and some sideways movement generally in there. And essentially what that means is that there is an untold, maybe invisible story in there. And of course, you don't necessarily see it clearly because you're just not using a fine enough lens uh, in order to see it. And so if you drop down the time frame, you'll kind of expose what that story is. So this is a 2-hour chart here. So if I drop it down to a 1 hour, and when I did that, that immediately showed me this. And this was the area that in fact kind of caught my interest here. And so right here we have a drop, a base, and a drop here. Okay. And so right here, price comes down, consolidates with these two indecisive candles here. Indecisive meaning that they are predominantly wick and obviously small bodies. This is basically a doji candle in here, and this one is let's say 55 or 60% body wick here. Then notice we have a very bearish move here, sort of an indecision candle there, and then that thump down here. So right here, supply and demand are in balance. And then right here, we have that exhaustion of buyers. Okay. And again, the expectation is if in fact this is a qualified supply zone, when price returns here, we're going to anticipate another wave of selling. Okay. So this is where I would actually lay out a trade. So the new setup is we basically delineate the boundaries of this supply zone here, which would be here, lay that out right there. We would then establish where our entry point would be, which of course that would be at the front of the demand zone, supply zone here, excuse me. So right there, okay. I'm looking at the daily ATR on this. This is about 270 a day. It moves on average. So I typically like to give the trade a little extra breathing room beyond the dimension of the zone. So I'll typically give it somewhere in the territory about 10% of the daily ATR, which means I would give it about another quarter here. So we're at 99.46. I would probably put the stop, let's say, at around 99.70. I would put that there. And so that essentially is what the trade would look like. Okay, we get in here, that's a 1-to-1, that's a 2-to-1, that's a 3-to-1. Again, we would look to either short the stock here or buy a put. Buying the put here, CCK, these are probably denominated, I would expect in $5 increments. So I would basically buy the 100, which would basically means that we would be buying this in the money by about what is that, about $1.15, $1.20 if we're at 98.84. So that would be the basis for that trade. And then in terms of establishing the target, this would certainly be our second target here because we have a kind of a rally-based rally formation. I would have to see essentially how this thing arrives at this level. If in fact it turns right here and starts to head up, then probably 2-to-1 is probably the first target right there. Because at that point, then you'll have this reversal here and price comes up here. So we can kind of anticipate that, but until it actually occurs, that's all conjecture at this point. So we'll see what happens. But anyway, that's your setup there. So again, we have a drop, base drop, price returns here, and this is where we would have a bearish trade. All right. So at any rate, I'm going to leave you with this. If you look at the pinned content right under this video here, you will see that there is a link to the introductory video that I did of this series, where I talk about looking at Barron's, kind of going into the reasoning why I was doing that, and then also doing a slightly deeper dive into that supply and demand concept. So you can take a look at that. So at any rate, that's what I got for today. So thank you for joining me. Next week, I will be looking at the November 24th issue of Barron's, and I'll be taking a look, obviously, at what the articles are and what the symbols are, and we'll hopefully come up with some other setups, and then I will share those with you. And then at the end of the week, we'll again do a wrap up and see where they all go. So at any rate, this is Mitch Firestone with Precision Trading Labs. Thanks for joining me here, and I'll see you next time. Take care. Bye-bye.